They actually stand for low exercise price options. And LIPOs are in fact, identical to futures contracts in the sense that they have what we call a specific margin system, which means they are market to market. And what I mean by a futures contract, just to make sure everyone understands how a futures contract works, when you buy a futures contract, you've therefore made a commitment to buy that particular asset or commodity. Whereas if you buy a call option, you therefore have an option to buy that particular asset, commodity, or whatever. A futures contract means you are fixed and you are obligated to buy that particular asset at that price. And as such, if the underlying asset were to go down in value, you would actually be margined on that. Whereas if you had bought a call option and the underlying asset went down, as you'll discover, the only risk you have is what you have paid. So there are some mechanics in this that you need to be mindful of. LIPOs have a strike price of 1 cent. They are only available as call options. LIPOs have a European exercise style, so just like the index options, they can only be exercised on the options expiry day. I've mentioned already that they are quite similar to futures contracts, and they expire on the same cycle as exchange-traded options. Your Ordminute advisor can give you more details on LIPOs, and so can the ASX. Now let's talk about now the option fundamentals. We've got a couple of fundamentals that we need to have introduced. And the fundamentals that we will talk about will be intrinsic value, time value, premium, premium decay, and then we're going to talk about a couple of Greeks known as the delta, theta, and gamma. So let us have a look at intrinsic value. The intrinsic value of an option is the difference between the market value of the underlying share and the strike price of the options contract. It may also be described as the real value of the option. And here's a table just illustrating how intrinsic value. Here we have a stock, it's worth $5. And you can see here on the first column, we have the call strike price. And you'll notice we have 4 different strike prices. A $4, $4.50, $5, and a $5.50 call option strike. And in the other column, you see the intrinsic value. Now, intrinsic value is very, very easy to work out in the form of a call option. All you simply do is take the current share price and subtract the strike price of the option. So, if the shares are currently worth $5, and you sell a $4 call, or you have a $4 bought call, and you would like to know what the intrinsic value is, it's simple. It's $1. 5 away from 4 gives you 1. And we would call that $4 call in the money. And it has that term because if you think about it, here we have $5 and here we have $4 in terms of the strike price. That is in the money in terms of its position relative to the underlying share. And then you just apply the same logic with the other strike prices. You go, let's say, to the $5 call or put, and we have a look at the stock at $5, and we can see there that we have no intrinsic value. There is no real value with an option that is what we call at the money. And if we go out of the money, say a $5.50 call, and we have a $5 stock, there is no real value in that option. There will be a time value, yes, if there is time, but as far as real value is concerned, there is none. And if we just go over to the other screen and we apply the same logic to puts. Now, just remember, however, if you have a put with a strike price of $6 and the share price is currently $5, that means the intrinsic value of that put option is again $1 because puts work to the opposite of calls. Now, if you go to the $5 put, it is the same strike price as the actual share, and we would say that has no intrinsic value, and we would call that an at-the-money option. And you can see how with the strike prices, they work towards the opposites. The best way to sort of initially think about options is just remember what you have with a call option. If the stock is currently $5 and you have a $5 call, it means you're at the money. If you have a $4 call and the stock is at $5, you know that you're in the money. And if you then want to think about a put, you just need to look at the strike price of the put. If the strike price of the put is greater than the strike price of the underlying share, it means that option has some real value and would be in the money. Now let's talk about the other component of options. This is the time value. The time value of an option reflects the market's expectation of what an option price will be at expiry. Time value is the greatest when the strike price and the underlying share price are equal, at the money. Premium is the price of an option. Premium will be determined by the market, and the premium is made up of two components. It's made up of the intrinsic value and the time value of an option. Let's have a look at this. Now we have a $5 stock, and we can see on the first row that's our call series. We have a $4 call, a $4.50 call, a $5 call, a $5.50 call. In the next row we see what the total option premium is for those respective options. So we see that the $4 call has an options premium value of $1.10. Now we can easily therefore work out what the intrinsic value is and the time value. To work out your intrinsic value, you would simply take the current share price, subtract the value of the strike price of your call option. $5 subtract $4 gives you $1. So therefore you know the intrinsic value is $1. If you know the option is worth $1.10, you can therefore determine that the time value of that option is only 10 cents. Now let's go over to the $5 call, and we know that's called an at-the-money option because both the strike price of the call and of the share price are identical, and we see the option's premium is only worth 30 cents. You'll notice it has no real value. There's no intrinsic value, but it does have 30 cents of time value there. And you'll notice if you focus on the bottom row there, the time value, you'll notice with an in-the-money option, it only has a time value of 10 cents. We go to the $4.50 call, that's still in the money, it has 15 cents of time. And then we go to the at-the-money option, it has 30 cents of time. But then when we go to out of the money, we go to that $5.50 call, which is out of the money, we see that the time value is only 15 cents. Now the time value is always greatest at the money for one reason and one reason only. It's called probability. And what I mean by that is this. If the shares are currently $5 and you have bought, say, a $5 call option, there is a 50-50 chance that the shares may go up or down based on that positioning. As such, the time value would always be the greatest. Whereas if the stock is currently $5 and you have a $5.50 call option, which is out of the money, the probability that the share price will be up to $5.50 and beyond, it's not 50%. In fact, it's a lot less than 50%. And therefore, the market makes the time value be worth a lot less. On the other hand, if the stock is currently worth $5 and you have a $4 call, so you are in the money, well, the probability that you will be in the money is obviously greater than 50%. So therefore, they're not going to pay you a much higher premium in terms of the time value, and that's why it's only worth 10 cents. So that explains where the two values come from. We'll just look at the same table for puts. We'll just run through that. Our stock is $5, and we can see here on the first row the put series, a $6 put, $5.50 put, $5 put, and a $4.50 put. And we see the options premium, $1.10, 65 cents, 30 cents, and 15 cents. Again, if you would like to work out the individual aspects of the option, if you know the $5.50 put option is currently worth 65 cents, well, you simply take the strike price of your put, you subtract the underlying share price. If you get a positive figure, that tells you what the intrinsic value is of that particular put option, and then you simply subtract that from your options premium, so 50 cents away from 65 cents means the time value is worth 15. This will become a little bit clearer when we actually look at a couple of actual illustrations of trading. Now, premium decay. This is actually a very important fundamental of options. Options, you will discover, are a wasting asset. The premium decays to the intrinsic value if an option has intrinsic value, and premium decays in an accelerating fashion. Now, this particular graph illustrates the properties of time decay. Now, let's just do an example here. Let's just cast our mind back and have a look at the, and let's presume that we're talking about a $5 stock and we're looking at a $5 call option that is currently worth 30 cents and we have, say, 3 months until options expiry. So you can see here on this particular graph, if you go to the y-axis, you can see it says 30 cents, and on the x-axis, that's on the bottom, that would be today. Today's the day when we look at the option. Now, let's assume that 1 month passes and the underlying shares stay at $5. They don't go up, they don't go down. Let's have a look and see what would happen to our option. Well, the option is probably worth now about 28 cents. And that makes sense because we've got a little bit less time. The value of the option has therefore decreased in value. Now, let's go out another month and assume the shares don't rise and they don't fall. They stay at $5. Let's have a look and see what our $5 call would be worth. It's now worth about 23 cents. So you're already noticing a pattern that the value of the option is starting to decay as the time is starting to run out. Now, this is a very important part here. You'll notice now that we're really at the final sort of third of the option's life, because we've put down here that there were 3 months for this option, so we're at the final third. We've got 1 month to go, and you'll notice here that we've roughly got still 2/3 of its value. If the underlying share stays at $5, does not rise, does not fall, and today now is the option's expiry day, we will discover that our option is worth nothing. It will decay to zero. And that's pretty important because there's a good rule of thumb that you should be mindful of, and that is an at or an out-of-the-money call or put option will lose 2/3 of its value in the final third of its life. So that's what you need to be mindful of about options. They do decay over time. They have a limited shelf life. So if that's the case, where is the optimum point if you're buying options? Well, it probably makes a bit of sense to give yourself sufficient time. So if you believe a certain stock is likely to rise in price, it's probably helpful for yourself to buy an option that has a little bit of time left in it. Sure, if you can buy an option that has only 2 weeks to go or even 1 day to go, but you don't give yourself much time. And yes, the option would be cheap, but sometimes you don't always pick the bottom in a stock, and it's important to give yourself a bit of time. On the other hand, if you're selling options, maybe one of the optimum points is to look in that final third of an option's life, because that's when the time decay will be working to your favour. So you can see there on that particular graph, that's the basic sort of places where you should be considering to be buying options. Give yourself enough time if you're buying options, and if you're selling options, you might want to consider selling them in the final third of an option's life. Now, having said that, that doesn't mean you go out and always sell options that have a 1 month expiry. That also might mean you can still look at a 3 month option. It's just in terms of the relative time scale that you're looking at. Instead of writing an option that might expire in 6 months, look at writing an option that might expire in 2 months or 3 months. But that will also be determined upon your own set of circumstances as well.